Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. All right. Well, welcome. I'm Chad Frantzen on behalf of Wealth Builders Investments. Thank you for joining us today for the September edition of our Economic Outlook. And we've got a number of you that are clients and some of you who are just friends, visitors, people we've met through the Wealth Builders Network. So first and foremost, I just want to say thank you to each of you for attending. And again, on behalf of our entire team at Wealth Builders Investments and Billy Epperhart, we're really glad you're here, glad you're committed to making an impact with your financial resources, your companies, your families, in what you're doing in the world. My goal today is two-part. I'm going to give you an update on what's going on in the economy, a lot happening. Second thing, I'm going to talk a little bit more about some of the work we're doing in Kingdom Impact investing. If you didn't know, I'd like to inform you that the Federal Reserve does meet several times a year. What's called the Federal Reserve, the Open Market Committee is the technical name for it. And they met yesterday on September 20th. And if you've been following me for any length of time, you know I've been circling this date on the calendar for what I thought would be a pivotal Fed meeting, and it was. And I am required just to share. This is for educational purposes only, and we are a registered investment advisor. Happy to talk individually with you about your own situation, but this content, a lot of it is our personal opinions based on our research and experience, but we are providing this for educational purposes only. I'm going to dig into the economic update. It'll be a little technical in nature, but we had a major meeting yesterday by Chairman Powell and the Federal Reserve, and the markets have responded. In fact, today, I got my little sticky note here. I was looking at it today. After the Federal Reserve's meeting, stocks, bonds, gold, silver, all of those asset classes are down more than 1% today. And in fact, the 10-year bond, I'm giving you a little eye candy here because I'm going to dig into this in a minute. This is my opening thoughts. Bonds are up. The bond prices are down, but the yields on bonds are up about 3-4% since yesterday's news coming out of Washington and the Federal Reserve. So why is that important? It's important because when we think about taking a kingdom perspective on managing your resources, we want to be disciplined. And I love this quote. I shared this last month. I ran across this book. And I think this really expresses the essence of when we sit down with families and we're creating our teams, the more discipline that team can exercise, the more freedom they have to maneuver. So oftentimes, you don't want to exercise discipline, or you don't want to train if you're in athletics. But the more we can exercise that discipline, it's actually going to give us more freedom, more latitude to look at opportunities, or just to stand on the sidelines and say, you know what, that's really interesting. I'm not going to take any action on that right now. And that in and of itself is wisdom. That's really the heart behind what we're doing at WBI Wealth Builders Investments. All right, so I want to share some stats here on cash. So we're going to talk a little bit in a minute. I've got some slides on what's going on with interest rates. What does that mean for the market, stock market, real estate, mortgage rates? So there's the old adage that cash is king. Well, if you look at all the major U.S. banks, from Wells Fargo, Chase, Bank of America, I've got those top 5 listed there. This is the interest rates on deposits for each of these banks. It's staggering. So look at that a little more closely. Wells Fargo's interest rate on deposits is 0.15. Bank of America is 0.01. I mean, these are all like a tenth of 1%. So what's happening in the banking world, and these are the big banks, right? Chase, Wells Fargo, Bank of America. I mean, this is almost all of us have had an account at these at what time or another. Um, Money is going out of these banks at a very historic pace. Now, when we talk about being good steward with your money, yeah, we'll talk about the stock market or investing in real estate or gold or private equity companies. But let's talk about how do you manage your cash? And I wanted to put this at the front of the presentation today because even in the last 24 hours, I've had meetings with two different clients, great families, and this topic comes up. What do we do with our cash? Whether it's personal or whether it's in a corporation or a nonprofit, actually three families in the last 24 hours. And this is where we are with interest rates. You'll see that the big banks are not going to pay anything. But when you look alternatively, a result of interest rates going up is that now CDs at institutions, money markets, or even U.S. Treasury bonds are all paying 4 to 5% annual rates of interest. Now, rates are subject to change and all that. I'm just kind of giving you here's what was out there this week when I put this together. So here's a major takeaway. If you get nothing else from today, or if you have to drop off early, think about how you're managing your cash. Inflation is not going anywhere anytime soon. I'm going to come back to that in a minute. But when you think about managing your cash, whether you run a nonprofit, whether you run a business, or whether you're just an individual in your own personal accounts, we've got to be really savvy on understanding, hey, the banks aren't going to pay us much for our reserves. Are there some alternatives that are conservative, safe, potentially even guaranteed? And the answer is yes. I've just kind of shown you part of our playbook at WBI, CDs, money markets, treasuries. We want to be getting 4 to 5% on our cash. And so if you're not getting that, shop around in your local market. I'm going to encourage you not to invest with the woke banks. You know, Billy Epperhart, my business partner, and I, we really encourage people to stay away, kind of shop local, look for locally owned banks, credit unions. And if you're going to work with an investment institution, if you're not already, we'll give a shameless plug here. We'd encourage you to reach out to us at Wealth Builders Investments. We can help you with cash management. And I would say every week, our team is going out and putting cash to work in some of these alternative areas, such as CDs, money markets, treasury bonds, kind of all over the country, really. I mean, you can live in the state of Texas and you could go invest in a CD or a money market that's not based in the state of Texas. So this is just good foundational food for thought here on cash management. I wanted to bring that up. All right, moving right along, I really want to jump right into what's happening with the Federal Reserve now. This chart I've had on the Economic Update webinar every month. The only thing different is I've added a note every time they've had a meeting. So again, for those of you who may be new to joining us, in the U.S., the Federal Reserve banking system is the central bank that creates monetary policy. So most importantly, interest rates. So interest rates affect the speed or velocity by which money goes through the system. So whether you're a student or a retiree or a serial entrepreneur, this is important because the velocity or the speed with which money goes through the economy has a lot to do with every one of us. If you go out to the grocery store or if you go out to get your car worked on at the repair shop, interest rates determine how fast money goes through the economy. When interest rates are really low, it's free money. Money moves fast. When interest rates are higher, the opposite is true. Now, I've added to my note for those of you keeping score at home. We've been tracking this year the Federal Reserve meetings. We had quarter point rate hikes February, March, May. In June, you'll see there I've got a big green hold. They did not do anything with rates. In July, they raised rates. And we've been saying for quite a while that September, that was going to be the meeting, a bit of a harbinger, if you will, of where things are going to go as we head into 2024. Now, bear in mind, that is also a presidential election year, so the stakes will be even higher. Historically, stock markets, bond markets, the markets in general have a lot more volatility. And I don't know why this is. They have a lot more volatility in the months of September and October than they do in the summer months or even the spring months for that matter. So what happened yesterday? I put it in here in my notes, but they did not raise interest rates. So you can see I have the word hold right there next to September 20th. So they did not raise rates. But what they said is that they were fully intent on keeping rates higher for longer. And in the world of Wall Street, what this is called is it's called a hawkish pause. So if you hear that in the media, it's kind of a weird term, but if you are in the world of banking, if you are really committed to keeping interest rates high and controlling the money supply, you are considered a hawk. If you're really committed to keeping interest rates low and keep money supply really, really free and flowing, you're considered to be a dove. Now, I didn't ask ChatGPT the background on that. That's just always how it's been referred to. So it's called a hawkish pause. Now, what does that mean for us? What it means is that the Federal Reserve, and I've got a couple more slides here, there is a high probability that they might raise rates between now and end of the year in November or December. But more importantly, they're going to keep interest rates higher for longer. All right. I read a lot of data. I follow a lot of different strategists and economists and thinkers and people that are way smarter than me. And I just follow what they do, and so I respect their viewpoints. So I've tried to distill some of the key points into these next two slides. So really what's happened yesterday is a major shift in the Fed policy. Okay. So previously the markets were expecting that a rate cut only about 3 months ago. The markets were anticipating that we could see interest rate cuts by the end of this year. Now, as of yesterday, the markets are no longer pricing in any interest rate cuts until September of 2024. Now, the markets can change, but that's the view that the bond market has right now. Excuse me. So if you think about it, that's fascinating. And in fact, the 10-year bond, and I'm going to show you a chart here in a minute, it is now at its highest rate since 2007. In fact, based on the comments yesterday from the Fed, there is the possibility not only that they will not lower rates, that they might actually raise rates one more time in 2023. So this is what's got the markets all disjointed, and it's quite interesting as an investor to kind of observe, what's getting priced in here. This is a chart here of the U.S. 10-year Treasury bond. And I don't want to get too technical, but I wanted to at least show you a visual of it. So what has happened is, and even today, this was, I think from yesterday, but even today, it's up higher, closer to 4.5. So this has big implications because that means bond prices are going down and rates, the interest rate on this is going up. Now, if you're wondering what does that have to do with anything, it obviously has a lot to do with the potential for a recession, number one. It also has a lot to do with money going in or out of the stock market. And then number three, excuse me, it has a lot to do with mortgage rates, which is another big factor. So this is really, you can go back on this chart to COVID, early 2020, you can see how low it was. It was at less than 1%. So this has been a huge move up and it's continuing to go. So right now, the average interest rate on a 30-year mortgage has now risen to over 7.5%. Now, the information I just shared with you, with the fact that based on what happened with Chairman Powell and the Federal Reserve yesterday, we don't see interest rates being cut anytime soon. Certainly at this point, potentially not till the end of summer of next year or early fall of 2024. There's a really clear path that we could see mortgage rates going up to north of 8%. Now they're over 7.5 today. Again, we're looking at just national averages, but with rates staying higher longer, it means that there's a clear path for mortgage rates to continue to rise. Now, the other thing that was announced yesterday is, I think we all know that the U.S. government has a bit of a deficit problem, if you will. It's well over $32 trillion in the deficit. And so one of the ways that the government pays for that is they issue bonds. And so there's more bonds being issued in the market. And as a result, this is flooding the bond market with supply, and that makes interest rates go up even higher. So that's not a positive thing when we look at equity markets. It's not a positive thing when we look at mortgage rates. The higher mortgage rates, and I think if we had Billy Epperhart on today, if we see mortgage rates this high for this long, I think that's going to have a real impact on the pricing on real estate prices, which I know a lot of you are real estate investors. I am as well. And that could create some good opportunities as we head into the year, particularly next spring when there's more supply. But 8% plus mortgages is strong. That's going to price out a lot of first-time home buyers and potentially affect prices. So again, even with this data, as a savvy investor, we want to be thinking, okay, so we don't walk in fear, right? We have not been given a spirit of fear. Well, we want to look at this from the lens of, okay, well, what's the opportunity that's going to come from this? And so I do think there's a handful of opportunities setting themselves up. I think some of them we have to wait on because some of these prices are going to get more attractive and give us better entry points on certain asset classes. Okay, yeah, here's a chart I threw in here. That's just the 30-year national mortgage. I quoted it on the previous slide, but the national average is around 7.60 on a 30-year mortgage. That's the highest since 2000. And I think it's, pretty clear path that mortgage rates will creep up to 8% and higher. So something we want to keep an eye on as investors. I think there'll be some opportunities, but this is going to create some pain in the economy. And that's not necessarily a good thing, unfortunately, for a lot of people who cannot afford to buy a home. They're kind of locked into where they are, right? I mean, why, if you own a home and you have a 3 or 4% mortgage, why are you going to move now if the mortgage is going to be 8%? You really need prices to come down more for the math to make sense. So yeah, in summary, the Federal Reserve meeting yesterday, again, part of the reason why we moved the webinar to recording it after that, because we really wanted to see what are they going to say. This impacts how we think about how we invest your money and how we invest our own money. And so I pulled this quote from an economist on Twitter, and this is really the takeaway is, the same institution, we're talking about the Federal Reserve, so this is not even a political statement, the same institution that brought us, there's no tech bubble in 2000, and in 2007, you remember, they said the subprime crisis is contained, and green shoots in 2009. Some of you may not remember this, but inflation is transitory in 2021. They're now peddling this concept of higher for longer. And the reality is this is going to bring more pain before we get out of it. And so historically, the Federal Reserve is not good at soft landings on the economy. I think we all recognize that interest rates are going to have an impact on the job market, on corporate earnings. And so that certainly influences how we're going to invest. Now, many of you, if you follow traditional Wall Street methodology or Wall Street advisors, not to pick on them, I was trained in that in that stream. But they are going to tell you, Wall Street's going to say, hey, just stay fully invested, stay in our funds. Everything's going to be fine. Buy and hold. You can't time the market on that. And for those of you who don't know, at our company, Wealth Builders Investment, that is absolutely not our philosophy. We think you do need to make some strategic decisions, particularly when things like what the Federal Reserve came out with yesterday about higher for longer on that. So again, we like to invest in 6 to 8 different asset classes at any given time. Now, we don't take an equal weight approach to that. And of course, obviously, you need to consider your personal investing objectives, risk tolerances, and suitability before you invest in anything, right? But for those of you who are clients, when we look at public equities in the stock market, we're underweight that asset class right now, and we're primarily focusing on higher quality companies and more dividend focused companies. So we're not doing a lot of heavy tech or companies that don't have really sound balance sheets. And of course, in everything we do on public equities, we're very focused on pro values, which just means we do not put the money in BlackRock or JP Morgan Chase funds or anything like that. We actually screen from the bottom up and from the top down for companies that have good market share, good earnings, hopefully dividends, but also ones that meet our pro values kingdom screening. So we are underweight in equities. Billy, I know, has shared in other forums. We'd really like to see the S&P 500 down, 15 to 20%. Now, it could certainly go down more. And in fact, what you'll find is the markets were down 1% today. It's not huge, but it only takes a small shift in consumer sentiment, and it could be mortgage rates hitting 8% that does it. That'll make a lot of people run for the doors, and we could see a bigger stock market correction. So from that standpoint, we're lightly invested, and we're waiting for opportunities at lower prices on that. Fixed income and private credit. I alluded to this in my opening slide. If you were taking notes there, a lot of what we're doing is we're buying investments in shorter term fixed income, either on the public or the private side, just because we want to make 4 to 6 to 8% without committing the money long term and without having to really have too much money in the public equities right now. So the fixed income has been doing really well for us this year. I expect that will continue going into the fourth quarter and into 2024 based on what the Federal Reserve announced yesterday on that. Real estate, many of you already invest personally in real estate. We do some real estate investing through our private funds. We are looking at specific geographic opportunities, typically in states that are a little more pro-business, low tax. They're probably more red states than blue states. And we think there's better opportunities there. And we're pinpointing more opportunities into 2024 just because prices are not quite where we would want them to be to really make larger investments. A couple of the other, let me just rattle through these last 3, and then I'm going to transition over to some really exciting news on Kingdom Impact Investing. Many of you, if you've been around our team, we like alternative investments. A couple of the asset classes we have had really good success with have been oil and gas, and then also a category which many of you may not be familiar with, which is called wildlife conservation. Both of these have some pretty meaningful tax benefits. Again, you want to consult with your CPA on that to see if it's applicable to your situation. But one of the things we like about both oil and gas and wildlife conservation is they are non-correlated to stocks, to bonds, to gold and silver. And they also provide really high levels of cash flow. Most of these investments will start paying low double-digit cash flow in the second year. again, that varies from year to year, but we like it because it's non-correlated, tends to be pretty resilient based upon where the economy is. And in fact, if you've been tracking your prices at the pump, I drive an F-150, and I noticed how much my bill is to fill up the truck. But oil prices, barrel of oil is up about 38%. I could be off a point or two on that over the last 6 months. So that's not helping. Again, that's inflation. That's really a form of tax with gas prices still extremely high. Oil is up, close to 40%. Bad for you and I at the pump. Um, Indifferent if you're driving an electric vehicle, but if you're an investor in oil and gas, then you look at it as, well, okay, oil prices are higher. They're higher. They may go higher. How do we use that as an investment thesis? And that's why we like oil and gas. So those are doing well. For those of you invested in those, I know some of you got into those this year. We're really pleased with that, as well as the wildlife conservation as well. The last thing kind of in our playbook, and this will segue me into talking about Kingdom Impact Investing, is what we call private equity. And so, as many of you know, I mean, there's a slew of public companies. You've got, Home Depot and Lowe's and Best Buy and Kroger and all that. But there are actually more private companies in the United States than there are public companies. So there are a lot more private companies to choose from when you're thinking about, well, I want some good pro values, profitable, good long-term investments inside my portfolio. We don't have to just invest in the S&P 500. You don't have to just invest in a BlackRock, thankfully. So there's a lot of opportunities in private companies. We call that private equity. And so what I want to talk about next is some of the work we're doing in that arena. And again, we're looking for long-term growth, but we're also looking for what type of impact these companies are having on the world. Well, I love this slide because I have a whole separate presentation that's called Kingdom Investing in a Woke World. It's one of the most popular ones when I get asked to speak. But I want to talk a little more about this with the time we have left. Again, I hope the economic update wasn't too boring. I wanted to really give you an update on what we're thinking because you'll be hearing a lot about this in the news. But now, for the next handful of minutes, I want to talk about our approach and what we're doing as we're doing more and more research. The team is on how do we really create an investment thesis for kingdom investing in a very woke culture, a very liberal, almost Marxist society that we find ourselves in. Some of you have, if you've been around me any length of time, you've seen this stat, but it bears repeating. There was an article in about a year ago in Christianity Today, and it did a study, found that $30 trillion in assets, and we're talking about the stock and bond market. I'm not actually talking about real estate, but $30 trillion in stock and bond market were controlled, stewarded by Christians. And these could have been Christian individuals, Christian organizations, Christian companies, but they were self-identified as that. And of that $30 trillion, only 8% of it was invested in any way that was what I'm going to call faith-based. We use a lot of concepts around Wealth Builders about biblically responsible, pro-value, social impact, but let's just call that faith-based, a Christian faith-based lens. Only about 8%. And so one of the things that Billy and I and the team feel called to is to help move the needle on this, because the more we can educate you, our friends, our clients, brothers and sisters in the Lord, the more you become aware that, wow, the money in my 401k or my IRA or my kids' college or grandkids' college savings, it's invested in, very woke companies. It's invested in the BlackRocks and the Googles and the Disneys of the world. but you can actually create what we call a faith-based screen or faith-based framework for doing that. So we want to be a part of changing this number. And I think that's part of how we change culture. When we think about a reformation in the marketplace and in churches, is part of it will happen through how resources are directed. All right. Again, for existing clients, you know where to find us, wealthbuilders.net. If you've never worked with us before and you would like to learn more about what we do, our team would be happy to visit with you, be happy to offer you a 15-minute complimentary consultation, kind of tell you how we work, provide you some resources, see if there's a good fit for us to help you work together or not, but at least encourage you in where you are in your financial journey. You can connect with us through the website. We also have a free resource if you're new to the WBI network, wealthbuilders.net/invest. You can go to that, and we've got a free financial survival guide there for you. So, all right. Well, I'm going to move over to some questions here just with the few minutes we have left. I really appreciate everyone being here today. Again, we do these every month, so watch your email. Feel free to invite friends, family members on that. We do it on a Thursday. Kind of depends from month to month, but let's talk a little bit about the price of gold. That's a great question. Interesting thing is the price of gold was down today. I do think gold's going to stay between $1,800 and $2,000. But I think for now, I think it could go over that. I don't. For me personally, that's where I kind of see it being. We do invest in gold, but just remember, gold's more of a store of value than it is, paying you any type of cash flow. All right. So thanks for that question. Let's see what else. I think it's important to keep your cash reserves high. That's one of the reasons why I wanted to mention that at the beginning. If you've got a low mortgage, I don't know that I would pay that off. I mean, if you have some higher interest rate debt, you might want to consider paying that off. But again, I think there's going to be some meaningful opportunities for investing as we get into first of the year, whether that's real estate, whether that's stocks. So I think keeping some cash on the sideline, I think, is probably a good idea. And I would probably look at doing some of those 4 to 5% investment options, whether you're doing it yourself or whether you'd like us to help you. Pretty straightforward on how to do those. Yeah, I think I'm just looking at a couple more of these questions. Definitely, I think the markets could easily see a 20% decline. It could be more. I know Billy has shared that he thinks personally, just his personal opinion, that it could be higher, a much higher drop. And statistically, when you look at history, that has been true, that rates have been lower. When rates get that high before they cut rates, that the market could go down significantly. Yeah, questions on 401k. Yes, if you have questions on how to invest in your 401k or 403b, any type of company retirement plan, we'll be happy to advise you on that. Feel free to reach out to us. Lots of good questions here. I appreciate it. I'm just scrolling through them all. We had a question on, a couple questions on real estate and housing. I mean, obviously, a lot of real estate pricing has to do with inventory, so availability of houses. So whether you're in Birmingham, Alabama, or Dallas, Texas, or Denver, Colorado, inventory is really the key. With mortgage rates going up and staying up for longer, that I think is going to have a big impact on real estate prices. particularly as we head into next spring, which is seasonally usually when we see more housing. So that's something that we'd really want to watch. I think there's going to be some opportunities, but right now a lot of people are being held hostage by their home because they have a 3 or 4% mortgage, and upsizing is going to be extremely expensive. Thank you to our friend from Norway. I am not familiar with Norwegian rules as far as how to invest in the U.S., but I'm super thankful for you being here. That's something we can look into. I'd have to find out. We do work with some people in the UK. I know it's country by country on that. All right, lots of good questions. This is a good question. What's the definition of long-term and short-term investments? It's a little bit subjective, but in general, I like to teach it as a ladder, and the higher up the ladder you go, the longer term your money is. I personally think it's wise to spread your money out. Um, you can think of money in a couple different ways. Money that is liquid that you could get to any given week, right? And so that's money in the bank, that's money in the stock market, short-term CDs. So short-term, medium-term, and long-term. Short-term, I like to think of as less than 12 months. And then intermediate term, usually 12 to 36 months is what I like to think of it. And then to me, long-term money is something that I do not need this capital for a vacation or for a down payment on a house or to pay taxes or to pay a college tuition bill. I am strictly going to think of it as long-term capital so that it can sit in there and do its thing. To me, that's greater than 3 years, right? And so that would be how I would define that. Yeah, great question. Mezzanine debt is just a form of short-term debt. It's most often used in commercial real estate for lending of money, typically on a 12 to 18-month term. So that's what mezzanine debt is. Good question. Thank you. Some couple of questions in here about rolling over retirement plans. I'd probably defer those just to one-on-one conversations, just because that's a very specific question. So please feel free to email me, Brian, or I know there's a couple others on here. As far as if you have a 401k at an old employer and you want to possibly roll it over, reach out to me, Chad at wealthbuilders.net, and our team will be happy to chat with you online on that. Joe, thank you for being here. I think I already answered your question. I think I covered most of them. Again, I really appreciate everyone being here today. We have recorded this, and so you'll get this since you're here and you signed up. You will get it in your inbox. So again, Chad Frantzen on behalf of Wealth Builders Investments, I want to really thank you all for being here. I hope the content was helpful, and I hope also inspirational as we think about how do we invest not only in the traditional ways, but also in ways that what we call kingdom impact. So thank you again. Please follow us online, reach out to us with any questions, and we look forward to seeing you next month on our economic update webinar. Thanks so much. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel.